Good morning, everyone. How you guys doing? Superstock still hates CSPs. And Superstock's just afraid of anything they don't understand. They always have been. And they don't understand a lot of things, so it's tough. Ready to be heard again. Last week was awesome. The first part of it kind of sucks. But after that it got really fun. Watching the big sports ball game today. What sports ball is that? Hey Jen. The Super Bowl. Oh, no. What's up, Taco Man? I will keep it short though today because it is Super Bowl Sunday, um, and I have very little interest in doing this for too long today. I have a lot of shit to do, so get the questions in, get them in quick. I just placed a $20 bet to win 10 million that Tom Brady would win the Super Bowl today. Get ready for Pontiff on Monday. Isn't he retired? How does you talk about how bad Philadelphia is again? I'm up 50% on my port for the year. Thanks, Gert. Go Chiefs. Okay. Is that who's playing? The Chiefs and the Eagles? Was it wise for me to get March 17 Tesla puts? I don't think it was a terrible idea. Tesla did peak at my price target from like a month ago. It looks to be beginning a downtrend. Um, I would say that it hit the confirmation point on Friday. This is would generally be considered a good entry. This could still pull back, probably to like the 204 level in the early part of this week. I expect we'll have a little bullishness Monday or Tuesday. I don't know which one, but there could still be a little bit left, depending on how the world is reacting to, the alien invasion. I hope you had a good weekend thus far. Do you think SPX will likely rally again this week with CPI, or is it straight downhill? I don't think. I mean, okay, so if CPI comes in hot or slightly warmer, that it'll definitely be downhill. If CPI comes in up, I don't think it's gonna have the same dramatic effect that it had in previous prints. But it can sustain some price action into SLD. Quick question. People are going to hate this one. If I loan out my securities for high cost to borrow securities, is it easy to recall if I want to sell? Yeah, you just sell. And then they're immediately recalled. Mo money. Is holding SQQ shares till we see big market downs a good idea? I don't want the volatility eating away at my position, and I don't want to worry about theta for something that may take a while. It's okay to hold it for a brief period of time. You don't want to hold it into a consistently rising market though, because it returns negative performance per day, right? So the higher the lower the level moves, the faster it drops. So in a stagnant market or a downtrending market, it's a great hold. But if the market is like grinding up slowly, it becomes really dangerous really fast. That's a good English, and I have very little understanding of all things NFL. I am therefore looking forward to being completely baffled tonight for the approximately 4 hours a game takes. That makes sense. Hey, Girk, what would you consider a good upstart entry on this potential earnings dip? I figure between 12 and 14, but I'm looking for some thoughts on what the low might be. Thanks. I think there might be a small opportunity sub 14. I don't know if they have enough time or liquidity to drop it significantly beyond that. So maybe over the next couple days, depending on pre-market liquidity, we could see, you know, a potential low around like 1390. But I don't think it would last very long. I was doing strategic investment last night in my hot tub. Checked back into risk return of CSPs specifically, as well as straddles because I'm new. Just thank you again for the knowledge drops. No problem, man. Didn't get a chance to take SPY position. Thoughts on playing AMD calls for a CPI print? IV is crushed. Good earnings might slow a drop in case of a bad print. Exits latest Tuesday, end of day. I suppose, yeah. I mean, AMD is probably not a bad target. I don't know how the options interest is over on that, if I'm going to be perfectly frank. I think it's been falling off a bit, so you may not have much to pump into. Let me take a look. 1 second. Generally speaking, I would have chosen something like Apple for that, but yeah, I don't know. Calls on AMD have been selling off pretty hard the last few days, and puts are picking up, so I'm gonna say this doesn't look like my favorite. I don't love it. There's a chance it bounces off gamma neutral, which it kind of did towards the end of day on Friday. It may pick up a little momentum off that bounce. But probably not a lot. CPS is gonna be hot. They changed last month's from -1 to +1. It could be, yeah. Outlook on SPX this week. Well, I haven't updated my charts yet. I usually don't do that till later tonight. Once I get some more futures data. But we kind of slipped into the lower range that I was targeting for Feb 17 puts. The mid range on this being about 40.20. An SLD drop from this price range equates to somewhere between 39.67 and like 4,008. Now, if I do think we have a little bit of rally potential up to that like 120 range, especially after finding a bit of support here over the last like trading day on this trend. So maybe Monday, Tuesday, we have a shot at like 120 before further downside with SLD. We may not. I mean, if CPI is negative on Tuesday, you know, we could easily drop down to that like 39.65 level. Our April 21 $100 puts on NVIDIA, too little theta. Not only are they too little theta, they're way the fuck too far out of the money. You can make money on the drop with calls that are that far out of the money, or puts that are that far out of the money, but remember that they're, you're just capturing extrinsic value increases. They're not for like a long-term hold. So if you have something that far out, you just want the extrinsic value on it to go up and you want to sell it. I know you don't normally play earnings. Okay. Yeah, I'm not playing earnings like I usually don't do. I'll wait to see how earnings goes and then make a decision afterwards. Is the market going to be under 4,000 by Friday? It could be. Yeah. Upstart may go up after earnings. It's hard to say. I have long positions on Upstart already. So I should be at least transparent with that. I have synthetic longs at $20. I have lots and lots and lots of shares, of which I've only sold maybe 30% are locked up in CSP or CCs, and then I have CSPs out as well. They're not really there for earnings. They're more there for like Feb March, but what's up, Jamie Diamond Hands? What are your thoughts on how long it might take for Upstart to return to $24, $25 levels after the dip? I mean, it can happen pretty rapidly, right? I don't think a large amount of the shorts got out on the most recent run. I think a few did, but not many. And the longer term shorts are most likely still holding. I don't think they really got pushed out significantly, and if anything, they added to their positions after we peaked. Can you take a look at ZOM? Prepping some longer term in the money CCs for SPX crash, oil pullback, thinking 90, 45 DT. I don't like selling in the money covered calls on oil right now. I think that with the escalation with Russia, I would be hesitant at least to sell, especially $90. I mean, you're talking about like a big collapse in oil prices. I could see like 115, maybe. Even like 110 seems a little risky. I don't think commodities are going to do worse if we have a bad SLD either. So you're trying to catch that like spring lull, but if Russia escalates again, oil prices are going to stay elevated through that traditionally low cyclical period, right? Yeah, I don't know. I wouldn't trust the seasonality of oil right now. I think it's too up in the air. All right, next weekly puts on SPY, finna print. Thanks, Gorkachino. I don't know. I don't know where you have them or when you bought them. I hope so. Thoughts on GME Feb OPEX, or are we expecting them to use the deferral to March? Are you going to have open CCs into Feb 24th? No. I'm not going to have any open CCs after the 17th. There's a deferral there, but GME, we'll go over GME in a minute, but there's they're real short on liquidity there. I don't know how much pressure they can apply to the downside. It's minimal. It's definitely not as much as like they could in December. What are some publications that you read for general info? I don't really have any specific ones. The value of news information is in your ability to assess it, not in its source. I try to make sure that articles are verified and not just rumor, like the rumor mill, but I mean, obviously your best source of news is directly from companies themselves. Your best sort of source of economic data is directly from the government. Most financial news articles are based off of those two sources, and then their opinion pieces, right? I would ignore the opinions, but other than that, I mean, I'd say most news sources are credible in their ability to deliver information, and they're only useful in your ability, as useful as your ability to assess them. If CPI comes in hot this time, is it the next leg down for the next month till the FOMC meeting? Yeah, it could persist for a while. Could you just do a quick play on option strat to show how much an SPX June 3400p would be worth if we get a severe drop to 3200, VIX to 40? I always confused about the comment you made before that in the event it would be worth like a house with high Vega. Yeah, not like a good house, but hold on. Is that gonna work? There we go. Put SPX 3400. I mean, I'm gonna be perfectly realistic with you here, though. Vega, VIX isn't going to 40 on a drop to 3200 unless it happens in like a day or two. VIX could move up into the 30s in that event, but let's see, we're targeting 3200. So, uh, yeah, at 3200, not that impressive. And it's still a 10x on your $30,000 invest or your $3,000 investment, but like a market crash is way different than a drop to 3200. Like in the event of a market crash, you're gonna see like volatility get blown out, right? And you probably see drops below 3200. Like a market crash isn't gonna stabilize in the 3200 range. You're talking like 2500 or so. But yeah, obviously in a crash type scenario, it would be like $100,000 a contract. Who's buying those contracts if you want to sell them? The people who sold them to you. Market makers. If GME were to run in March, do you think we can reach $40 given its current state? I think 40 is excessive still. Our Gamma Max is still at like $26 and it's not budging a lot. So unless options interest on the long side picks up significantly, I would say right now $40 is out of the question. That can change, but right now I would say it's out of the question. What CCs do you have out on GME at the moment? I have them sold between $22 and $19. With a few at like $24.50 that are still open, I think. What are your thoughts on market movement this week? If CPI comes in at 5.8 to 6.2 or 6.4 or 6. Oh, sorry. I mean, those would be both of those points would be exceptionally bullish. The consensus estimate is 6.2. It's forecasted to be at 6.3. Both of those would indicate a continued cooling in CPI. I don't think continued cooling in CPI is going to have a huge effect I think it's already expected, mostly priced in. There may be a little upside due to a cool CPI print, but probably not above like 6150 or 4150. Hope yours is too, Lawrence. Thanks, man. There's still a bunch of unresolved liquidity on GME and Upstart and long vol positioning. It gives hope for one more real OPEX in Feb or March. Yes. Upstart got a little bit more covering than GME, and it's being used a little less quickly, but that's because GME options interest is just generally higher than Upstart's. So the market makers on Upstart don't need to use as much synthetic liquidity in the hedging of options. Whereas with GME, they have to use quite a lot because interest didn't pick up a ton during the run up, but it picked up a bit. So right now, I would say GME is a little more illiquid than Upstart, although Upstart's getting kind of close. Hold on one second. I think I need to. I don't have the study set up for this. Not a ton more liquidity, but a little bit more. So Upstart a little bit more liquid than GME. Still never realized a significant amount of liquidity. And they're still very much entrenched in their short positions between like really between 20 and like $35. If we look for the last period of contraction, right, in Upstart's liquidity, which is, after this run here, this is when the bigger part of the current shorting occurred, right? Here and here, obviously, when we became very, very illiquid. But throughout this period is where the majority of the current Upstart short exists, right? So that's between around 30, 35. Well, the majority of the volume here is around 34. So it's between 34 and kind of like right here at 1290. I still think some of the shorts down here are underwater right now. But they did clear out some short positioning and some like a little bit of secondary market liquidity, right? So a little bit of both. So a little bit of covering, a little bit of secondary market liquidity, but not a lot. And we're still very illiquid, right? We realized less liquidity than we realized after the last earnings for Q3. So I think there's still a big short position, synthetic and long, that is currently in this price range. Oh shit, sorry. Goddamn, I don't know why that keeps resetting. I guess I'm updating my new video drivers. So yeah, big short position, synthetic and long between these 2 points. That determined by the illiquidity driven from this point where we realized our peak liquidity in the last year, through the current time period where we were still significantly more illiquid than we were back then. And then this can be exacerbated by the buyback program. GME, on the other hand, has just stayed pretty illiquid. They covered a little bit here, through this period, through our deferral period. We saw some covering, and then really nothing. Like, so most of this price action that occurred after the deferral period was a pretty concentrated attempt to prevent a breakout by using XRT liquidity, which dropped massively, right? In order to prevent a breakout. So after they got done covering here, they started using XRT to prevent any continuous breakout above the level where they're very short still. They were mostly successful in that, I think, with the only real risk-off scenario occurring on that day where we got the double halt on AMC and Bobby, and we kind of saw that big buy order come in that got sold off the next morning. Thinking April or March, 3,700 SPY put. If we can hit 412, would you say this is not a half bad strategy? My only thought is that using the option strat price decays almost immediately. You're kind of low. I mean, yeah, you're April. April might not be terrible, but I mean, at that point, you'd almost want to confirm, like Q1 earnings. The contract will go up, but I don't know if it'll go in the money. Right. I think your strike is too far out of the money for it to go in the money, at least in the short term. But it's close enough to the money that it can pick up a very decent amount of like extrinsic value, maybe more than its theta decay. Do you have a downside target in mind for Baba? Yeah. $95.59. Thanks, Sam. That's what I was wondering about during the COVID crash. Some of your contracts, yeah, that was actually a crash. I bought, I averaged into a lot of them and they were way out of the money when I bought them, and some of them went in the money. Also VIX, yeah, VIX went to like 80. But yeah, there were a few contracts that intraday hit like 220, 250x. They're not easy to sell. People don't want to bet on the bull side. You usually have to sell at the bid, and you take some losses on that. But yeah, you can really see some crazy. The Vega's insane, right? So as IV pumps, especially intraday on volume, um, your multipliers astronomically high, especially the closer you get to the money. By the time you're like at the money, your Vega's like 8.0, so it's like an 8x multiplier on volatility. I mean, option strat can't even like you can't really calculate a market crash on option strat. What CCs do you have out on GME at the moment? Okay, I answered that, I think, already. 2450 down through 19. 19's my for the lowest strike right now. Starbucks a good short, PT at 95 reasonable. They've really been turning around. Um Maybe ex dividend was Thursday. Their yield isn't very impressive, so that probably won't trigger a large sell-off, but I could see them declining with the market. At least a little bit. Quarter two earnings aren't until May. I probably wouldn't target 95, but maybe like 105s to capture like a test at 100. Or maybe 100s to catch a test of 100. Um, yeah, 100 is going to be really strong. Not a lot of profit taking here from the accumulation that occurred down in like the $70 range. And I think their guidance was pretty strong too. You may want to double check that because that's just like secondhand information, but I remember I heard some people talking about their guidance being pretty good. Do you have any open positions on Crocs Q4 FYE earnings and pre-market Thursday, Feb 16th? If it dips into Wednesday, then I'm thinking about picking up some 125C 217. I don't play earnings. I will say that Crocs makes 25-cent shoes that they're able to sell for like $25 to $70. So might be worth thinking about. There's no straddle potential on GME. I wouldn't play it. I think it's a terrible idea. It doesn't move enough. You need expensive stocks to play intraday straddles on. Really expensive ones. You need small percent moves to be large notional moves. GME is not worth it. Longer term straddles on GME are probably fine. Especially if you can like roll, if you have extra capital, like roll your puts and calls. But even those, they're really only good to enter when volatility is extremely low. And when volatility's up, GME's price is up, which makes the short side of the straddles really kind of useless. How much RAM do you have in your computer? Like 64 gig, I think. I've been seeing posts on Discord showing XRT put open interest increasing, which coincides with previous runs. How relevant do you think this is to previous runs we've had and a potential next run? It's important that they're loading up XRT. Remember that those puts are likely bought either to mark long positions, like created positions that will inevitably fail, or they're being used to hedge open forward contracts on the on that are being used to balance XRT's NAV. So I think in February we'll see probably one of two things occur with the current open interest on XRT. I think we'll either see XRT end up on the reg show list again, and then we'll start to see the borrow rate climb, or we will get a run. There's a deferral there, and I would say that the use of that deferral is completely unpredictable. Barring no war aliens, do you think SPX bottomed? I think it can go up over the next 2 days, but I think it'll go down for SLD pretty hard. The short interest is quite big, and we had a fairly low VIX on the most recent high, so it's leveraged as well. I asked if you're bullish or bearish about Upstart earnings. I'm bearish on their profitability. I don't think they've had enough time to really reach out into the newer markets they're targeting in order to increase loan volume. I think they'll have had to have taken more of the loan principal onto their balance sheet because the credit markets are still not stabilized. But they have made some cuts, and I'm sure that they've done a little bit of work in padding those losses. I think the company long term is a very good buy and well managed. But I do not expect a lot from the current earnings. The share buyback would be the most, not like the highest potential for price improvement. And frankly, I think it would be not in their best interests without confirmation from the Fed to deploy too much of that buyback right now. So I think they probably took advantage of the low prices. They probably bought some back, but I don't think they've deployed the entirety of their buyback. Good money being made right now is Trump cards. Took a gamble off it, and the floor price is now $1,000 per card. Media will not talk about it. Oh, okay. I don't care. Are those like the NFT things? Can you please give a basic framework of meaningful catalysts that affect stock prices for basic trades? I'm not asking about ETF secret sauce, but more like consistent catalysts. Well, rebalances are a big deal. I don't really know if you could call those a catalyst because they can skew either way. But generally, like you have periods of the year where larger numbers of ETFs are rebalancing, and that creates a lot of volatility, if nothing else. Intraday, I mean, there's a constant flow of ETF interest that affects all stocks for the most part. Hertz is one of my new favorites. Give me a reason to hate it. I actually don't. I think the company's doing pretty well. For longer term target play, so like NVIDIA puts, what's the best way to approach them? Hold far dated contracts at halfway to PT, tilt PT with a stop, or trade multiple contracts all the way. I mean, you want to take profits, like when you hit resistance or there's a potential for a pullback. If you stagnate for too long at resistance, um, it's just like playing any other out of the money position. You want to take profits on it. Obviously, like if I were going to short Nvidia right now, I wouldn't be just buying like $100 puts, right? That just seems fucking stupid. These are all the way down here, right? Like I would buy like at the money, slightly out of the money, like probably like 0.5 through 0.05 delta, right? And then sell as it drops, probably shaving the out of the money ones, holding the in the money ones, and capturing the delta value from the drop. There's a lot of fucking resistance between 212 and $100 though. So even though I think over time, like Nvidia's worth that, the realization of its actual value could take quite some time. You can't just assume because something is worth X that the market is going to price it at X immediately, right? And right now Nvidia's trading at 212. I think there's a ton of downside room. I think it could be a great short for not just the first like middle of this year, but the second half of this year, maybe into next year. Um, but don't be greedy with it. Don't expect it to all happen at once, unless we get a market crash. Mark Long is not a person. Stefan, thank you so much, man. I hope you're not just trying to get people to come in and bag hold your Trump playing cards. I can't imagine that's a super liquid market, given that the media is not talking about it. Hey, Girk, I work at a job where I can't pay attention to the stock market for most of the day. How would you manage your option strategies? I would play it tighter. I would buy a lot more theta, and I would set conditional orders in order to capture profit or stop losses for periods of time where I was unable to watch the market. I would also Probably go to the bathroom more often. I wouldn't buy into any option strategies that were in like within a 30-day window. Like I would want strategies that were targeting like 45, 90, or 180-day windows. That way I would have plenty of time to enter them and plenty of time to get out of them. So if Feb OPEX gets deferred, then it would be pushed to March 8th to 13th as shown on the FINRA rule. The holiday deferment, yes, but Rex codes also. The holiday extension is like it's like automatic, right? They don't even need to apply for the holiday extensions, but they can then add Rex codes onto the holiday extensions. And that can give them enough time. Generally speaking, we start to see the settlement of secondary market liquidity from the holiday extension date, and then it carries through over several settlement days into the OPEX period. So remember that settlement extensions move settlement days. So your T date, your trade date, is what is moved. All of the things that are applicable to a trade date are still applicable on the new date. So market makers still have T plus 2 plus 2. ETFs still have T plus 3. Well, they have plus 3, and 5, or plus 3/+2. So all of these are still applicable on the deferred date. Appreciated, Girk. Unfortunately, there's no bathrooms on the railroad. Okay, that's fair enough. So yeah, you want long-term horizons. You know, you want to do things like this is an example, and I'm in no way recommending this trade, but like say you were looking at NVDA and you were interested in a short position, right? If I were in that position, I would be looking, at something like 200 or 180, like near the money. I would be looking to get 90 to 180 DTE of theta. That way, my option gets in the money if I'm correct quickly, right? If it doesn't, I'm able to sell it without losing too much value. And then once it's in the money, I have a lot of time to choose when to capture profits. Right. So that's kind of what you're looking for is you want to get in the money quick, or even you could even start in the money. And you want a lot of time to be able to manage the position. So yeah. So something like that, right? There's a million different things that you can target that way. You're just looking for much longer swing trades. You want to use, like, if you're using moving averages or technical analysis, you want to be looking out on the daily. You want to give yourself a very decent amount of time. So you're probably looking at like 3090 or 5200 EMAs or SMAs. You'll want to fundamentally focus your trades more than technicals, though. For SLD, is there a way to determine how much of a sell-off is expected? Nope. Here's what SLD is. It's a period of time in which something might happen. Lately, because the market is over leveraged, that something has been sell-offs. It's been negative. That's not always going to be true. That may not be true right now. Short positioning isn't super over leveraged right now, and it's definitely not in a extremely risky price range, at least on the indexes. So I would say that I'd lean more towards like a 200 BPS drop. Like we'd have to see selling on the long side of the trades. for margin extensions, because right now the short side is doing pretty well going into this week. And we may have already seen some selling on the long side of the trade this last week as we move down from the top, because they can sell those securities at any time. They don't need to sell them during the SLD period, even though that's most common. They don't have to. They can sell them in advance. They can sell them during. There's no way to know. Or some tried and true stock catalysts that every trader with his or her salt should know. Macro data. Macro data and earnings are like the two like most followed catalysts. So as we discussed about NVIDIA puts, would you say if I got June 150 to 170p conservative for them to go in the money, by then they are appropriate to hold for a longer term through a Q1 period? Yeah, if you're once you're in the money, you're in a very stable position, right? Especially the more in the money you are. You know, if you're holding options, if you're holding a put that's like 0.7 delta or 0.6 delta, you know, you're basically just short the underlying at that point. Like in terms of risk, at least. I'm thinking value of 100 after Q3. So I've got 150 September right now. Probably got some closer delta contracts for April then. Yeah, generally what I'll do is, you know, I'll have my theta extended the further out of the money I am, right? So I'm buying relatively the same delta, but it's spread out. Like if you look at the FSLR play, that's a really good example. Almost those contracts are almost all the same delta. Even though they're different strikes, right? Because the theta increases delta. This is accurate. Depending on how active an options market exists for specific ETFs, it's false. That'll cause more or less delta hedging in this underlying stocks it's in. Yeah, that's not true. ETF doesn't have to have an active options market in order to affect the underlying stocks. What's the downside to 90 130 day stats you just went over? Capped profit versus shorter dated contract. Yeah. Less leverage. You get a lot less leverage. So your rate of growth is significantly slowed down. I think that would be the most damaging thing. I'm incapable of managing my port responsibly, no matter how often I go to the bathroom. Best strategy, wait on PIFA hedge fund. I mean, you could just buy shit low and sell it high. Right, like not like a meme, but like, you know, buy things when they're cheap and, you know, wait for like growth, like value investing. It's not that bad. I mean, if you're good at it, you can make a lot of money with very little, you know, risk. What are your thoughts on volume profile and order flow charting on ES to get a better feel for sentiment on SPX? Is it worth getting proficient in? I don't think so. Volume can be volume on futures is very sporadic day to day. I don't think you're gonna get a lot of consistent trends that are gonna tell you much about sentiment, especially given how much hedging is done in the futures market. I think it's a kind of like a false flag for sentiment, if anything. Order flow charting, intraday volume, okay. Knowing where people are positioned and where they're hedging intraday can matter, but I think longer term it's probably pretty useless. You say don't play earnings. How is that a tried and true catalyst? Most market participants do play earnings. And that's why it's kind of a self-fulfilling prophecy. A lot of people do play earnings. Funds play earnings, like value investors play earnings, because they want to sell or buy more shares based on the earnings outlook. Although the time of day that most of that activity occurs, retail is not really well positioned to take advantage of. And then macro data, I mean, Fed announcements, big reports like Michigan consumer sentiment, like S&P PMI reports, flash reports, any big economic shifts politically, uh, individual fund data, that kind of depends. The more uncertain the market gets, the more heavily it weighs macroeconomic data. So, but there are lots of like macro catalysts. Understanding the macroeconomics would probably help you a long way to knowing what and when will be a catalyst and when it will be. Because, like I've told you before, Stefan, nothing in the market is tried and true. It's all a variable, it's dynamic. Some things are more important sometimes than others, and other things are more important the rest of the time. If there was a hedge fund, we'd all buy it when it was high and sell at all-time lows. How's the market look for March? I don't think the market looks very good for the rest of the year, Mark Long. To add, we beat estimated earnings by 30%. This needs to go up. I don't know what industry you're in or what sector. I mean, if you could be more specific generally, some industries and sectors may do very, very well. Others probably not so much. I sold some bear call spreads on NVIDIA. The short leg is profitable enough to pay for the long leg. Does it make sense to close the short leg, the long leg? Yeah, you could. It's risky. I assume that's what the rest of your sentence was going to be. You're leaving a naked call open if you do that, which has infinite risk. Why are you bullish on uranium? I wrote about it. I'm bullish on uranium because the number of reactors being opened far exceeds the current supply, and the current supply has been cut. So, and uranium is simply bought at the price it costs. And unlike other commodities, increased price does not reduce the necessary demand. So it is capable of running away. Like the pricing is capable of running away. And the largest uranium producer in the world, which produces like a shitload of the world's uranium, I think it's like 60% or something, cut their estimates this year for production by half. Yeah, other than reactors, uranium doesn't have a lot of use. But all over the world, there are treaties and agreements being put into place that are pushing green energy, and right now, nuclear power is the only base base grid power that's green, that's acceptable or scalable. Do you think Nvidia has peaked? I mean, maybe it could kind of like double top this week. That's why I haven't bought puts yet. You can use condors, butterflies, short strangles, short straddles. There's a lot of shit that where you're just selling time decay. If you just think sideways. Although the longer things go sideways, the less profitable those strategies become because volatility reduces, right? But yeah, just those are like standard income strategies. Most of them are pretty profitable on flat markets. Last year you mentioned uranium is probably 3 to 5 years out. Is Kazaprom SP? What? Kazataprom? It's Kazatomprom. Could the main change causing more expedited timeline? It can cause a near-term expedited timeline. Their supply issues can resolve, right? And then demand for uranium is still higher than production, which can cause uranium to continue trading at a premium for the next few years. But the more nuclear reactors they build, the more demand increases, and they're currently building far more nuclear reactors than they are opening up uranium mines. That and the escalation of the situation. Russia's the sixth largest producer of uranium in the world, and right now they're not exporting it to anybody. Right? They need it for their own power stations. Um, and yeah, obviously the trade embargoes from Russia, and then Kazakhstan, in addition to its supply drop off because of the lack of materials needed to mine the uranium, they have difficulty transporting anything through Ukraine right now because of the war. So it could accelerate the timeline slightly. Most of the 3 to 5 year timeline is a larger scale demand being built up from new reactors being built. So right now, China ramped up like 120 different coal power plants like over the last 2 years, and so their coal demand is at like all-time highs. But they're replacing those with nuclear reactors that are currently being built. And so when that shift begins to happen, China's demand for coal or for uranium is going to skyrocket. U.S. is building more nuclear reactors. European Union's building more nuclear reactors. So all of that's going to increase demand on a supply chain that's already very weak. You keep mentioning Michigan sentiment. I'm from Canada. I thought Michigan was such an insignificant. It's a Michigan university. The University of Michigan's Consumer Sentiment Report. It doesn't just interview people from Michigan, although that would be funny. Also, there's a lot of other issues in Kazakhstan with increased inflation and their government's not doing well, and they could have political instability, which could really cut back the supply of uranium. What's the best way to get uranium exposure? An ETF? Yeah, there's a few uranium ETFs. SRUF is really good for speculating on rises in the price of the commodity because as the trust trades at a premium to its NAV, it begins buying more uranium, right? And that drives the price, like the spot price of uranium up, which then drives the price, the value, the NAV of the fund up, which causes more speculators to come in. And so it's a reflexive market mechanic. And then when prices go up, obviously, people want to buy more uranium because they need it, right? And then, you know, those buyers coming in then further drives the price up, and there's no supply to increase there, right? And so you can get kind of a runaway reaction. Keep in mind it takes 7 to 10 years to build a reactor from plan to energy out. I'm aware. The current reactors already create more demand on the supply than is available. But the planned reactors over the next decade, especially concentrated in the next like 5 years, far exceed the current supply of uranium. Some of which are already being built. Oh, I think I missed Dork. URG, aren't they like an exploration ETF? Like, it's like focused on uranium mining or something like that. Runaway reaction. That part of the world is economically and politically unstable. Why was Kyrgyzstan several years? Was that Kyrgyzstan several years back paying cabbies less than $5 for an hour trip? Yet produce costs same, like here in North America. Yeah. Okay. Well, that's fucked up. Yeah, they've got a lot of problems in that area. All right. Well, does anybody else have any questions? This one dried up quick. The market's pretty simple this week. TMF thoughts? Mm. Your Treasury bull. How long of a hold? Why would you hold a 3x ETF long? You're gonna, even if you go synthetic long, you're still gonna suffer volatility decay. You can't stop the volatility decay. See ya, non-C-SPAN. Monday, Tuesday this week, I'm probably just going to continue hedging the upside. I straddled into Friday close. I'll hedge the upside probably Tuesday for CPI, and then I'll pull back the upside hedges if we run for CPI going into SLD. No, there's potential for some ups. I think SPX can still move into like the 4120, 4125 range. There's still a shitload of call interest up there that I don't think is gonna be allowed to expire worthless. If Upstart did a small buyback, would you expect any sort of pricing increase in price or higher floor until next earnings? Yeah, it could. I mean, obviously it destroys liquidity, right? So it can make it harder to short. Depending on the extent of the buyback, it could have even stronger effects than just a slightly higher floor increased price. Have your thoughts of the market have changed or stayed the same? My views on like the market long term are still pretty similar. I don't expect things to get better this year. I expect things to get progressively worse. I don't know if they're going to get bad enough that we're going to see a crash. I know IMF gave a little hope in saying that the US is unlikely to see a recession in 2023, but I don't know if that's entirely true yet. I still think we could hit a recession in stride by Q3, Q4. Crashes are a black swan event, right? So like they're never guaranteed. A drop to 34 or 3200 is not a crash either, right? Especially if it's a slow drop on, dropping valuations. Crashes still need catalysts. I think there are catalysts, quite a few of them. Generally, do you think growth stocks aren't a great hold through this year? I mean, it kind of depends on the stock. Some things do very well in recessions. Some things even do better in recessions. Also, manage my money. I missed all last week. Is my best bet for GME to sell my CC early this week for 217 expiration. I probably wouldn't go in the money at this point unless we see a big bounce back Monday or Tuesday to like the $20 range. If I were selling CCs this week, I'd probably be out of the money just because the risk of SLD wrapping up into the end of the week and pushing some upside price improvement. Like I have in the money ones I sold last week, but they're already very profitable, right? So I can close them at a profit, even though they're still in the money. But if you sold one this week, it'll be harder because you'll have less extrinsic value that you sold, and so you'll need the intrinsic value drop to be able to buy them back. I sold some Fubo 24, Jan 24 2.5p and bought Jan 24 3c. Since the prices dropped, did you average into more of the same strike or adjust and sell the 2p and buy 2.5c? Yeah, I mean that's an option. I probably would have just taken profits on those instead of continuing to hold them when you were up, but we might have missed it. Yeah, I mean in the two the point of that synthetic long position specifically is that you're able to sell one put and buy 2x long leverage, so you're 3x leverage to the upside. It's close to 3x, like 2.5x leverage to the upside. It's like creating your own little 3x ETF. Isn't the catalyst simply a bad outlook over a long period and institutions wanting to get out as profitable as possible? Yes, but that doesn't necessarily mean a crash, right? Institutions may sell off very slowly over an extended period of time versus selling off all at once. And that's the difference between a recession and a crash. Ever any recent news on Japanese economic policy? Are things getting any better over there? No. Japan's still attempting to keep their consumer side inflation at like 2%. So no, it's forced the Japanese central bank to step into the FX markets more and more in order to improve the value of the yen, but it's not helping them a lot. So I think they're probably running out of options. Although, they've been doing this shit for a long time. Then the guy they recommended for the BOJ had declined the offer. Bleak times. I mean, it may just not have been that great of an offer, right? There's no way to say why he declined it. I mean, if you go back to like 2001, right? I would say this period is very comparable to like the dot-com bubble. And if you look at the effects of that, right, uh, through this period, there wasn't ever really a big crash. I mean, kind of in like from like March through July of 2002, we finally found a bottom. But this was all on just declining earnings, right? Like earnings just kept getting worse and worse, and we just kept going down. So, even though this is considered like a big crash, the only real crash part of it we got was like right here, a little bit here, but mostly here. Where we had a pretty large sell off in SPX, or like the S&P. And that rallied and then kind of dropped again. And then, as earnings improved and we got into, PEs that were more balanced, the market started to improve again by like, 2003. But yeah, you can have extended bear markets. I mean, this lasted from, April of 2000 roughly, August of 2000 for almost 2 years, right? This is an extremely long period of time that this went on. All right. Well, thank you guys so much for tuning in. I'm gonna cut this one a little short today. I'll let everyone get back to their sports ball and such. If you guys have any questions and you weren't able to get them to me on the stream, hit me up on the Discord. I'll be around for most of the rest of the day doing pickles pick stuff. So, appreciate you guys hanging out, and I will see you tomorrow morning. Have a great rest of your weekend. Good night.